But let's go to our first guest, Michael McCarthy, Chief Strategy Officer at Tiger Brokers. Thanks so much for your time, Michael. Let's just start with those interest rate hikes from the US Federal Reserve and the Bank of England. Markets usually fall when interest rates go up, but they've been climbing this week. What's the driving force there?
It's a good question, Edward, and not an easy one to answer. At the same time that we saw share markets rally on the back of the Fed and the BOE lifting rates, we saw bonds selling off and we saw the US dollar strengthening in a sign of a flight to safe haven. So share markets appeared to react in exactly the opposite way to the other major markets around the globe. And some of that may have been relief that a number of events were out of the way. Certainly share markets, particularly in Europe, but also in the US, had reacted very badly to developments in Ukraine. The potential for peace, or at least a less protracted conflict there, seemed to buoy the share markets much more than it did other markets, and might explain the reason why we finished with such a risk-on note in today's trading, with, as you pointed out, all those growth exposed sectors at the top of the tree, and at the other end of the tree, a poor performance from the safer healthcare, telco and consumer sectors. So despite the fact that it was a wild week and a wild ride for investors, we've finished on a very positive note.
Yeah, the Reserve Bank of Australia now seems like it's under a little bit of pressure to lift rates, with all of its global peers starting to lift rates. If the RBA does raise rates this year, what impact might that have on the ASX 200?
It's likely to slow things. The studies show that during tightening cycles in the first 12 months or so, we often see share markets rise with interest rates. That's because the reason interest rates are rising is because the economy is starting to improve. However, that's not the case this time around. It's rising inflation that's really driving the actions of central banks around the globe. And that rising inflation is not just a threat to the broader economy, but it's a threat to corporate bottom lines. And so for that reason, an acknowledgement of that with a lift in rates by the RBA could see an immediate negative reaction on the Australian share market.
There's been a lot of volatility with the oil price over the last couple of weeks. Do you expect that volatility in the oil sector and commodities in general to continue for quite some time?
Absolutely. The reality is that an 8% gain in oil prices in a single session is just as concerning as a 4% drop. That sort of excessive move suggests that the volatility we've seen over the last few weeks will continue for some time yet. Now, that is not a directional call. It could happen in either way, but clearly it's very sensitive to Russia's role in the Ukraine conflict, and any further moves, any aggression from Russia could see a very quick reversal in the direction of oil prices tonight.
And it looks like over the last couple of weeks, we've seen travel stocks start to slowly rebound. They've had a tough couple of years. Do you think the outlook's a bit brighter for them now?
Well, it's certainly improving. And of course, let's never forget that underpinning a lot of the improved outlook is the emergence of economies from under COVID restrictions. COVID itself is still very present around the globe, but societies are more willing to deal with it on an everyday approach. And so that potential for so many industries to bounce back as people emerge from isolation is a very important factor in thinking about company profits. So it's very hard to say which strands will dominate over the rest of the year, whether it'll be that expansion in the economy that comes with the emergence from COVID, or whether it's the crunch on the brakes from central banks. And I think that's why investors are about facing so regularly, as we saw this week, going from positive to negative in a very short period of time.
One of the worst performers today was Star Entertainment Group. It's currently facing a regulatory inquiry which is investigating whether it's suitable to hold its casino licence. We know Crown Resorts has been through this. I guess it was just a matter of time before it was the Star's turn.
Absolutely, and it certainly turned up with some share price pressure today. Star Group shares trading down to a 12-month low in the morning session today as that news broke across investors. It is very concerning, and given that we're only 2 days into an inquiry that's expected to last weeks, or at least the public hearings of that inquiry, there are real concerns we'll hear further bad news for the Star Casino Group. Ultimately, if there's enough malfeasance here, it could imperil the licences that they hold for their 3 casinos. And if that's the case, that'll have a very material impact on the bottom line, a very concerning development for Star Group shareholders.
Yeah, and the other part to this as well is Crown Resorts has agreed to that $9 billion takeover by Blackstone. Do you think if Star's share price goes down significantly over the next few months, there could be a chance Blackstone might be interested in buying Star as well?
It's an interesting call. It would seem to be highly concentrated. And of course, I think the ACCC and the FIRB might have something to say about such a move. But certainly in value terms, there is that potential. The problem, of course, is that the COVID effective earnings look terrible at around 6.1 cents a share. Even on a normalised basis, they're only approaching 9 cents a share. And given that the stock traded above $3 all day today, the multiples here look quite eye-watering. Nonetheless, these are potentially growth businesses if there is a full recovery in economic activity. So I've no doubt that some people are running the ruler over the group right now, but possibly waiting for further developments before making any moves.
And just on the market front again, the other constant that I've seen over the last couple of weeks really has been gold. Gold miners are consistently in the top performers. What's the driving force behind that?
That's a fascinating one. Normally, if we're seeing a strengthening US dollar, we see it putting pressure on gold. In the current environment, it's unlikely that gold will act as an effective inflation hedge, given the disconnect we've seen between inflation and economic activity. Yet, here we are looking at a gold price on the rise. Today, the gold price itself was fairly steady around the previous all-time highs around 1940, but gold stocks performed well. However, they raced out of the blocks and the sector was up, or the subsector was up around 1%, but finished much less higher than that, only up about 1/3%. And that suggests that the major drift today was from day traders who are buying the stock in anticipation of a good move. Nonetheless, it's very clear that some investors are very concerned about the outlook, and for them, gold represents a bolt hole in these uncertain times.
And Michael, you mentioned healthcare stocks were a bit lower today, but surely the outlook for healthcare is pretty bright when you look at Australia's ageing population.
Absolutely. The demographics favour the healthcare sector. The problem is that's been known for a long time, and the prices for a long time have reflected that. And so there's not so much the safety or even the ratios that investors might find attractive. Certainly dividend yields relatively are okay, but nowhere near what they once might have been in the sector. And there is, of course, potential for that growth, but that's been largely factored in. So they now become a play, very much a defensive play. When the outlook for the economy is uncertain, healthcare comes into vogue. Clearly, today that wasn't the case, and the bulk of investors were looking for a better economic outlook and shunning the healthcare sector because of it.
Well, Michael McCarthy, Chief Strategy Officer at Tiger Brokers, thanks for your time.
Thanks, Edward.